Is the market crash over? Is that really all there was to it? Or was the biggest bull trap of this cycle just set? There's been recent rotations into value-oriented plays, but with the Iran deal headline rocking the markets higher on Thursday and Friday, will rates ultimately come down and reverse the risk-off trade? I mean, it's definitely something I'm watching ahead of the FOMC meeting on Wednesday, where the new Fed chair, Kevin Warsh, will have his first real opportunity to address markets. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 10 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we're left with a red-bodied hammer candle where the lower wick is substantial in terms of magnitude. We know that it indicates buyers stepped up off the lows of the weekly range and were able to bring prices higher into the upper third of the weekly range. However, because it is technically a red-bodied bar, the close is still underneath the opening print. An even more bullish hammer would have been a green-bodied bar where we close over the opening print after experiencing some range expansion in the upward direction coming off of the low. That's not the case, but I mean, please, let's think about this logically. Is the structure still bullish? Absolutely. Let's segue into location on the bar-to-bar count. We've got a lower high here as well as a lower low, but let's just take a look at where the candle closed. It's back inside of the previous week's range. It's actually over the previous week's close. This is a classic look below and fail. So although yes, in the sequence of counting, it's a lower high, lower low, the close is actually a little bit more bullish. If you tuned into last Saturday's update video where we were looking at the weekly timescale, you know that it was really all about the 2-week equal lows in here at about 730. If we took that out, then great. The bears had an opportunity to prove a lower high underneath and seek a deeper weekly pullback into about 712, 710. We talked about this last Saturday. We also brought up that if the bears failed and we experienced look below and fail, which is exactly what's happened so far, where should we target? Probably at least the equal high. We should probably look back to the all-time high if we start getting up and out of last week's range in this upcoming week's worth of trade, right? That would be the next logical target, to test an equal high after pulling back on the weekly chart and setting a higher low, right? Because in the trend count, we really haven't pulled back since coming off of the major low in late March. If we break out the Fibonacci's, as we've discussed in prior episodes, I mean, the low and the high have not changed here. All of this, in terms of this being the pullback, has happened over the Fib 38.2. We're not even close to retesting the previous all-time high breakout level. This is a very bullish higher low on the weekly timescale. If we break out the anchored view apps on the weekly, what do we see here? We're above the entirety of the stack. If we take the anchored view app from the major low, we know that that was better confluence around that 712, 710. The market didn't even make it there. Once again, if you're a stronger bear, how do you want to see the weekly bar close? I mean, you're begging for, if you're a bear, a weekly close underneath that level, get us into this area. On any counter trend bounces, you then want to see something that maybe looks like this, lower high, and then the bears step right back up. You know, I'm totally being hyperbolic here about what the bears ideally would be, foaming at the mouth for. This is a bearish situation for sure, where the weekly trend changes to down. Excuse me, let me bring out the crayon. There we go. Via some sort of lower high. If you're a bear, you're like, yeah, of course that's what I want to see. This is not that by any stretch of the imagination. And, we'll see on the daily chart that there's definitely some concerns walking forward from here. It shouldn't be, too easy or a cakewalk, so to speak. There's definitely things to pay attention to, but for the most part, this is the opposite of what I've just drawn. This is sellers failing underneath a very critical area of support, aka the 2-week equal lows from back over here. We also know if we throw on the volume profile, right, and just zoom out here, that was the high volume shelf, right? If I do something that looks like this, there's a high volume shelf, low volume void underneath us, and really the top end of the previous all-time high was the next major volume shelf, and the market just got nowhere close to it. I will also show you here the monthly expected move for June. We pierced the bottom end, but then closed back inside of the monthly expected move. Obviously, there's still many more weeks left, or 2 more weeks left in the month to close out here, so it's not like it's game over quite yet, but for all intents and purposes, the market's doing what it should do in an uptrend. It's finding buyers and generally not rewarding those sellers who are especially late to the party at the lows of this overall move. Let's get on down to the daily time frame. Let's just take a closer look here. Let's get granular, as we say. Let's firstly start with this week's expected move. Obviously, the market is closed on Friday. If that wasn't obvious, well, heads up, the market's closed on Friday. So we have a shortened holiday week here. The expected move is naturally going to be slightly smaller. The upper bound is at 755.69. 649, still implying a slightly lower high versus the all-time high back here. And if we're contained by the lower bound, the number is 727.81, which, if you want to split hairs with me, is technically a higher low versus last week's low. So you could sort of call this range compression, if you will. And if you're not familiar with the expected move study, feel free to check out the video tutorial in the top right-hand corner. Generally, expected move here, again, neutral. I would probably lean on slightly more bullish. As long as this higher low is holding in here, I wouldn't be overly concerned about the lower high. Is it something to have in the back pocket as a threat? Absolutely. But, generally, weekly higher low, trying to seek continuation out of this trend. If we think about the nature of the pullback here, this was really all kicked off on Friday now of 2 weeks ago when we got that hotter than expected labor report and rates kind of made that move higher. There was a number of other arguments there, like, oh, they're just punishing all the pattern day trader rule, abolishers who started to day trade wildly with their small accounts here. Just gave them a little hope on Thursday, came in on Friday. Whatever your thesis was, I primarily align a little bit more with the labor report, let's say LB for labor report, putting pressure on rates, unwinding some of the super leveraged trade in semiconductors over in South Korea as the dollar went higher, right? So say that's the kickoff. Does that really end the AI narrative of the market? Once again, probably not, right? The AI build out is still here and real. Obviously, these hyperscalers are spending every cent they have on it. So that doesn't really destroy the narrative. And this just kind of looks like a mechanical pullback from poorly located longs getting out of their longs, being punished ultimately, and resetting the inventory position of players as we come in for, as described on Wednesday, not even roughly, it's pretty much spot on the money, a 5% pullback from peak to trough here. If I just do this, you could see, yeah, there you go, 4.98% from peak to trough. You get a 5% pullback about 3.4 times a year. And of course, obviously the April situation, the big breakdown there, or I should say pre-April situation, gave us one of those 5% pullbacks. And here's another one. The market is supporting over the daily 50 SMA. And if we're thinking about candle structure here, yes, there was an excess low produced on the Tuesday session. I'm not convinced that this is a fully structurally sound low. It looks like to me you'd need a little bit more excess down there. I'm not calling for lower lows, and I'm not looking at this through the lens of like, okay, I think the auction's unrepaired, it has to be short, we need to come back down and tag it. But if you do notice in the coming weeks worth of trade that we start taking out this weekly low spot that we were just talking about literally on the weekly chart, to be precise at 732.25, if we take that out, then I would imagine that you're at least going to have to test this. You shouldn't have equal lows like that. You're probably going to overshoot the daily 50. The best bullish reaction would, of course, be something like this, if we're going to remain bullish on the higher timeframes and still acknowledge this as a higher low pullback on the weekly. The worst situation would be that this actually fails on the reattempt, and then you're lower, in which case we're definitely starting to reevaluate the weekly higher low closer towards that 712.40, which we just saw was confluence with the fib 38.2, as well as that anchored VWAP from the major low coming off of late March. So that's if the market tests lower first. The other thing to point out here is if the market tests higher. If the market starts to get tangled up in here, I want you to be very cautious of the narrative getting super noisy online about, oh my goodness, it's a head and shoulders. And on Wednesday, if that starts to show up, guess what? You'll probably see it in the thumbnail. But if you actually listen to the video, right, what are we probably going to say? If you pull back in here and can catch a higher low, it's going to be such a fast Uno reverse card that this is going to be a left, head, right, inverted head and shoulders, and higher in my perspective, so long as Kevin Warsh doesn't outright come out and say, hey, we're hiking interest rates right now because we just want to get this over with. As long as that's not the situation on Wednesday, this pattern to me looks slightly more constructive for either just, you come in here and you go sideways even, that's fine. If this, offers continuation like that, that would satisfy that weekly higher low, looking for the equal high. Again, I don't want to be overly pessimistic here coming off of a 5% pullback into the 50 SMA in a market that is red hot off the lows, right? All the money on the sidelines. This was the opportunity to sort of get involved in the pullback. If not then, over the next handful of weeks, right? As markets start to offer us new setups in high beta, in things that are really related to the AI build out, potentially, a number of different themes in here. Obviously, SpaceX going live on Friday. You have the healthcare theme. There's just so many things to keep track of in this spot. To me, this is a bullish close. So without further ado, let's drop to the hourly chart. Let's get a little bit more granular in terms of the interpretation of the hourly trend reversal. We know the daily trend was down. As a matter of fact, I probably could have done a better job here. this, right, is a lower low. We talked about it on Wednesday, so maybe, hopefully you watched the Wednesday video. It's a lower low, and the thread, of course, is a lower high in here. That's the head and shoulders we were just talking about. But on the hourly chart, Friday was instrumental here because what it's done is it's actually taken the hourly trend back in the upward direction via the break of the double bottom neckline. This is a set of equal lows, and this undeniably is a higher high in the 1 hour trend count, meaning if the market pulls back, there's room for an hourly higher low now on this time frame, as long as the market either consolidates here in a picture perfect world over the neckline, that's 738.15. I would look at this through the lens of hourly bull flag after the double bottom neckline break, try to get up here towards that daily right shoulder zone, the top end of the previous left side peak, right? From here, you have another chance. If you make an hourly higher high, you have another chance for an hourly higher low. Pullbacks that then sustain a reclaim of the daily 20 SMA, that's the orange moving average here, should continue the pressure and the walk in the upward direction. This is satisfying that weekly equal high we were just talking about. If this gets dicey, the hourly trend changes back to down. Where's the hourly head and shoulders prove that the buyers are under pressure? Probably back underneath this level, right? If you bring in that hourly lower low on an official hourly trend reversal, that's what the bears, sorry, this should be higher low first. If you turn that into a lower low via a break over here, and this is speculation, I'm saying this is a lower probability outcome based on what I can see, and we'll talk through the supporting evidence, but that would be what the bears want to latch onto. If the market pulls back instead of going higher first like that, if we pull back, is this still not, I know it would be a little bit odd because you're back underneath that neckline, but is this not still an hourly higher low? Of course it is. And you're also, if you respect that, setting a daily higher low over the weekly pivot. So in my view, there's reasons to be optimistic about this trend reversal. I would say a handful of other things, just as it relates to the news and the way that this market actually moved higher. In the pre-market on Thursday, it was like, hey, we actually might strike Iran. And then intraday, the market gets the news, I think I'm going to cancel that, and we're actually closer to signing a deal than we've ever been before, right? All I would say is when in the pre-market, it was said that, hey, we're actually going to consider strikes, right? The market wasn't even able to take out the previous day's lows. It wasn't even able to take out, even if you just want to use Tuesday's low, the market was unable to take that out. I still think this is an improper end of the auction, seeing how close those lows are. And if the market reverses, I would be concerned about 725. But in terms of interpreting the price action from Thursday and then the follow through on Friday, that seems constructive. Where on bad escalation news, the market's unable to make a lower low. And then on positive de-escalation news, the market actually goes out and sets a higher high in the hourly trend count. So that seems constructive to me. Let's come in here with the Fibonacci's. Let's take a look from here down to here. Notice that the neckline is confluence with the Fib 38.2. In a picture perfect world, holding above that really prevents the narrative of bear flag on the hourly. If we fail back down below, again, still optimistic for that hourly higher low here, but probably the best case situation is staying over the Fib 38.2. Let's come in from the major low of Tuesday up to the high from the rally of Friday. And what do you see here? I mean, Fib 38.2 is in this neighborhood, so does this qualify as bull flag on that hourly? As we just said, I would tend to think yes. You could also see, not for nothing, but the Fib 61.8 is in the neighborhood of that weekly line in the sand at 732.25. So it's really three very important levels to be paying attention to next week. It's got to be here. That's kind of line in the sand for the bulls. You're maximally bullish as long as we're over 732.25. You're here talking about a higher low, also very bullish if you're above that. And any breaks over 744, just continue the hourly trend in the upward direction. So that's my take on the intraday here in terms of dissecting the price action into the end of last week. Let's go with the intraday anchored VWAPs. Notice, and we talked about this on Wednesday, that the anchored VWAP from here, perfect, right? That's the April 8th gap up, the first major de-escalation from the war where the entire tone of the market changed. You're bouncing right off those anchored VWAPs. That looks fantastic. If you anchor a VWAP to the low, specifically 1230 on the Thursday session, notice that on Friday morning, you respect that anchored VWAP and it's right there. It's right at that 738.15 neckline of the double bottom. And, heck, if you want to even take it back to the Friday session and say, okay, this is the day where the market tone actually changed, right? Where's that Friday low? Excuse me. It's right at that level still, 738.15. So the levels, the market structure here, in my opinion, is very, very clear. The objectives are very, very clear where the buyers are still in control. It's going to be very clear when the market changes tone, if the market changes tone again, where the bears are saying, you know what? We're not done with this thing. Heck of a bull trap, right? as mentioned from the intro. So with that, let's go ahead and continue into some supporting evidence, starting with our market internals here. If you're not familiar with this, market internals, check out the video tutorial in the top right-hand corner. I mean, Thursday, as soon as the news comes out, big, strong volume inflows. Friday follows it up with decent inflows as well. I'd say respectable inflows rather than being overbought. If you look at the advanced decline line, once again, respectable, not overbought. A little bit hairy on the actual index score. That's because Mag 7 has been such a drag on the marketplace recently. They're still super heavyweight, and it's definitely important, but the high beta stuff did sort of snap back there into the end of the week. If you look at the cumulative builds, strong into Thursday's close, a little bit more lackluster and flat on Friday. I don't think that's unreasonable, considering that it's mainly a headline-driven move to the north side, but as we'll see through additional supporting evidence, and I'll just show you this chart now because why not? Let's go to the RSP. It actually made a brand new all-time high on the Friday session. So typically, when we're looking at the market internals dashboard in hindsight, not using them intraday as an active trading tool, we're trying to gauge market breadth. How did the overall components at the exchange level act? Well, hard to argue with breadth when RSP is literally a brand new all-time closing high on that Friday session. So with that, we'll go on over and finish up the S&P with a look through our market profile. If you're not familiar with market profile, check out the video tutorial in the top right-hand corner. What do we see here? Impressively said that value is lower on that Wednesday, Thursday session. Point of control is untested. That's a VPOC, we'd call that. And notice that value is constructively higher on Friday. So once again, does this seem like a firm footing on the rally? This is not really great excess on the lows. Again, very equal to just stack all these things up. The VPOC is untested. Could we get a deeper pullback towards it? Maybe. What I will say is if you look at this sort of like single print delineation of Thursday, let me just zoom in on it. H period there. I know it was so quick when it happened, but there it is. H period does mark some singles. Did the market come close to testing in the lower distribution? We'd call that D2 on the Friday session. No, the market came into the upper distribution. As a matter of fact, it was a perfect pullback into the value area high. I'd call that mechanical. Short-term momentum traders kind of in control there, bounced right off of it and then closed, I would say, in an okay spot back up in the higher portion of the range, right here towards the highs of that session from Thursday. So constructive move in the upward direction, absolutely. And maybe another reason to bring this up is we talked about this thing called the toppling effect in market profile, right? Where if value was really left here on Thursday, if all the value was up here, then it's going to be easier to say, okay, if we break underneath Friday's low, then great. All of these participants are proven wrong. However, because value is lower on the Thursday session, these participants who are long from down here may still be content, right? On a deeper test underneath Friday's low, it may be okay for something to come in here, still find support, look below and fail, reclaim Friday's low, and then you're back higher, right? Treating this as a stair step in the upward direction, just based on the positioning that we could see here and the volume profile. So not the end of the world as it relates to the interpretation. We also do have a poor high at the tippity top of the move. You can see here in D and E periods, back-to-back TPOs. Ideally would use some repair there. Let's get back on over the platform here and let's reset and take a look at the QQQ NASDAQ 100. What's going on from this perspective on a weekly clean drawing set. And of course, we're gonna go ahead and throw on our simple moving average stack. There we go. Weekly look of the Qs. There you have it. Just like we were talking about in the S&P 500 weekly chart, we had a red-bodied hammer over on the S&P. On the NASDAQ, we've got ourselves a green-bodied hammer. So what does that imply? Again, the difference here, you still get that opening drive in the downward direction for the week. That's primarily from Tuesday. And then you get the rebound, but instead of just moving back up towards the upper third, you actually move through the opening print, range expand here, and close above the opening print, offering some sort of firmer footing for the buyers. You'll notice the same thing in terms of bar-to-bar count. You've got your lower high and lower low, but look at the close, clearly constructive over the previous week's close, and just like the S&P 500, your 2-week equal low experiences a look below and fail, and ultimately the target should be the equal high to satisfy the trend count on the weekly. So in my view, almost identical, but probably slightly more bullish, right? As we take out the Fibonacci's perhaps coming in from the low up to the high, just to be congruent in the analysis, you've got yourself all of this action happening over the Fib 38.2. If you throw on the anchored VWAPs, all of it happening above the entirety of the stack. And as we know, if we just throw on our volume profile, just to go through all the metrics here, it's the same thing. Look below and fail on the high volume node, no rotation through the low volume void. Forget about a retest of the previous all-time high. This is bullish, right? The sellers, once again, just to play out that same narrative as the S&P 500, I'll just use a line drawing this time. Sellers want to see weak close down here, another follow through week, any counter trend rebounds to set a lower high, follow through again, and then maybe you're talking about something in here to bring you a monthly high or low, but that it's just not even the conversation. The conversation is sellers failed underneath that 2-week balance low and probably looking for equal high satisfaction of the trend count on the weekly. Let's get this thing down to a daily time scale. Let's take a closer look over here. I think the arguments are probably already showing up all over the place online. Oh, look, it's a head and shoulders, right? The biggest argument I have against this is just going over the SMH and take a look over here. At least on the first go around on the SMH in this neighborhood here, you actually broke the neckline after setting the right shoulder. That was a fairly concerning close, but oops, sorry, higher, right? You go back and you look over here. This one's kind of botched, but nonetheless, there's your head and shoulders, right? Left head, right shoulder, equal high, or even, just call it double top, whatever. Oops, higher, right? And the most obvious one was back over here, left, head, right, and then you have a gap down into the neckline this day here. Oops, higher. Right, so the head and shoulders pattern is only really the head and shoulders pattern when you're getting acceptance underneath a neckline. And in this market where, once again, the labor report from Friday of 2 weeks ago, which kind of kicked off the selling in the first place, doesn't do anything to really derail the AI narrative in terms of productivity gains. The AI build out isn't necessarily stopping because you got a slightly stronger than expected report. Rates moved higher, and so far they have unwound some of that, especially on the back of crude oil coming in, just to be kind of surfing around here. Crude oil comes in a little bit, right? You can go look at your ZN, which of course is bid off these lows. You could go look at your 10Y, which is your 10-year yield, coming in, selling off that high. Generally, if we go back to the QQQ, I would be less interested in calling for head and shoulders up here, although again, I probably will use it as a thumbnail, so you got me. If they do something like this, it's probably oops and higher in the future, and look for the inverted head and shoulders reclaim of the neckline if we need to test that low in the first place. Now, what I will say about the daily timescale of the Qs is that there's a better excess low, just noting the distance and sort of the incrementality, if you will, of the low from Tuesday of last week versus Wednesday and then Thursday, right? It's not as equal of a low versus the S&P 500, so this does feel a little bit more so like an excess low. This is happening over the 50 SMA. As we take a look here, technically you did drift into a daily downtrend via a lower low, as described on the midweek video. There's still some threat that this possibly turns into a lower high, but I think I've been pretty clear about my thesis. It's less about looking at that lower high and more about where's the sideways and then this. Where is the pullback that gets everybody bearish, and then maybe it's even a deeper undercut. Oof, there it is. Close the gap. And then you're here, right? That is a stronger play back in the upward direction, in my opinion. Even if once again, and I think I mentioned this maybe in last Saturday's video, but I'll say it again. Even if you do get this and then whoosh, you're back up over this weekly low, maybe manage expectations a little bit. I would be bullish there, and I think it's worth looking for longs at this location. It doesn't guarantee that, oh my goodness, we're going to just, keep rallying another 20, 30% in the NASDAQ here. The idea might be like, okay, it's the right idea to get bullish back in here, but maybe keep expectations for a little bit more sideways. Let this turn into a weekly bull flag, and then we figure it out in the future, right? That's also a possibility. Again, still the right idea to be more bullish than bearish on a reclaim of range low, but just is it more sideways as opposed to straight up this go around? It certainly could be. So clearly the levels are well defined. You got to get up and over about 722 to obliterate the right shoulder. If you look above and fail, sure, the sellers may have something to do here, back into about 709.25, in which case, if you overshoot that, I would primarily be along the lines of this. Weekly lows 699. It's the lower bound of the weekly expected move. I didn't call out the numbers yet, but here it is. Upper bound is 743.65. That's almost an equal high to the all-time high. It's a slightly lower high. We'll split hairs. And this is undeniably still a higher low versus last week's low. So 699, 700. And on the top side, 743.65. Once again, shortened holiday week. So maybe a small compression of volatility, but I wouldn't expect too much of a compression of volatility. We'll see why as we move through these charts. So that's your daily. A reclaim over this 722. The shoulder mark would also get you up and over the daily 20 SMA. Once again, if you do this, close the gap, support the daily 50. Also not the end of the world. I would be looking for longs at this location, much less shorts, right? Let's jump on into the hourly time scale. Let's take a closer look over here. You could see the same commentary as to what we were just describing on the S&P. There's your higher low double bottom, a little bit more bullish bullish than the equal low double bottom. There's your neckline. Here's your hold above it on Friday's morning pullback low. That means in a picture perfect world, consolidation in Friday's range that leads to higher is bullish for the hourly trend count. This undeniably is your higher high after a higher low. The hourly trend's naturally up. If we pull back deeper than that, that's okay. Your neckline's here. 709.25, reclaim 714.65, at least 722, still looking at a 1 hour higher low, trend count remains up. If this starts to fail, okay, pressure here wouldn't be a major bear on the low, and instead I would think, okay, where's the look below and fail, get back bullish for something that looks like this. If the market starts to spend time down here, different story, we'll reevaluate if there's some sort of fundamental shift in the data points. Maybe NVIDIA's Jensen says, hey, we got you, this AI thing, it's all fake, we just totally fooled you, right? What are the odds of that? 0. The only thing I'm really a little bit more mindful of course, is the market's response to Kevin Warsh on the Wednesday session at 2 o'clock. That's the FOMC. So those are your pullback situations. If the market just rips, as we mentioned in the S&P side, if you just naturally go out to a higher high, fine. I mean, you could close this gap, you could come back in, you could set a higher low. Awesome, fantastic, probably expecting something like that. The only time to maybe try this market short, if you're hellbent on trying to get short the market and you don't believe in the thesis we've set forth so far, what you want to be looking for is an hourly trend reversal back to down. So if you're really trying to short the market, I'll give you a little something here, bears. You have to see a failure pattern on the highs. If you're ever at the highest high of the trend count, you can't just short that until you actually see a failure pattern on a slightly smaller time scale. So if this is going to be a lower high on the daily, great, your hourly trend needs to offer a failure on, some kind of rejection here. You could position short. That way, even if you're wrong about, a complete market wipeout going to 0, at least you can trade for some decent enough risk reward into the higher low pullback that you can cover some of your risk and, you take it from there, right? So that's what the bears maybe have to go on, but I would certainly think lower probabilities of that. Let's get on into our intraday anchored VWAPs. You can see similar to the S&P 500, very clearly defined levels, 714.65, 709.25, your weekly lows coming in here at that 699. If you're over 722, makes things look a heck of a lot better for, in simple terms, there's your inverted man ray pattern, right? One double head, right? We'll draw him upside down. There's his 2 eyeballs, and here is his mouth. There's the evil villain from one of the greatest TV shows of all time, depending on how you feel about TV shows. Anyways, QQQ, sarcasm. Let's jump into our market internals. We'll hit this with the fib. Why not? We hit the fibs on the spiders, so we'll do it on the Qs as well. From high to low, you could see perfectly 61.8 dramatically increases the odds of a 100% retracement, and fib 38.2 is confluence with the neckline, 709.25. Perfect. Could not have asked for anything better. Let's come from the low up to this high, and what do we see here? Fib 38.2 right over the neckline once again. Could not have asked for anything better, and 61.8 slightly north of the big weekly line in the sand, but pretty darn good if you ask me. As always, they're just reference points. You wouldn't second mortgage the house on them, but they are aligning with the structure that we're seeing. Let's jump on into the NASDAQ side of the market internals. What do we see here? Huge, monstrous volume inflows on Thursday as soon as that reversal of the war headline comes out. You've got yourself a decent volume read on Friday as well. Kind of respectful in there, honestly, not overbought. If you look at the advanced decline line, again, respectful on Friday is what I like about that. Huge ramp on the cumulative build on Friday and pretty flat on, Thursday, and then Friday, pretty flat. So overall read of market internals, once again, still bullish here. There's nothing that's overly derailing the bear narrative or derailing the bull narrative to make it bearish, I should say. Let's jump on over into our market profile for the NASDAQ side of the market. Let's see what's going on over here. I mean, the ranges are so large here. You get that weird sort of, see the pattern blur on, I don't know, it's a screen thing. Anyways, the point of the exercise is that we've got the same thing as what we had over in the S&P 500, where your value area is lower on Thursday, value is higher on Friday. Even if the market pulls back and sweeps the low of Friday, these participants, I mean, the point of control is literally at the low of the day. The longs who are positioned from down here are still happy. Even if you just overlap it with the Wednesday value, this is Wednesday's value box right here from bright yellow to bright yellow. I mean, there's room to sort of test that Friday low, clean it up, and then possibly go from there. I shouldn't even use the term clean it up because there's great excess in this A period. There actually is a decent volume taper on that Friday session, right? Beautiful taper of volume there. Point of control closes higher in the session, and we have a little bit of a lack of material excess on the top side. Let's jump back on over the platform here, and let's take a look at one of the most underrated spots in the market right now. We joke around all the time in the morning show that nobody likes the Rusty Russell, but I mean, the Rusty Russell just went out to a brand new all-time high on Friday's session. The close isn't great. Let's go up to the weekly. Let's not skip parts of the process here. Let's see what's going on from this perspective, of course. But what do we have? I mean, again, look at the candle structure versus what we covered in the S&P and the NASDAQ. They incrementally get better. The S&P had the red hammer. The NASDAQ had the green hammer. The IWM has the largest expansion of range, green hammer-esque bar with the lower wick. That looks pretty darn good to me. So structure is absolutely bullish in terms of location, bar to bar count, lower low, but also higher high, bullish engulfer. Right? We clearly close well off of the previous week's close at the high of this week's range. Structure, location, buyers in control here on IWM. Is this just a very nuanced higher low pullback? To me, looks like the answer is absolutely. If we throw on a Fibonacci, as we described in last Saturday's update, let's get the click, please, think or swim. There we go. This is all happening over a Fib 38.2. It's happening over the previous left side peak. That looks pretty good to me. Let's go ahead and throw on our anchored VWAPs here over the entirety of the stack. Didn't even have to test this one. That's looking pretty darn good to me. Just generally, small caps are acting as a huge beneficiary from, once again, the lower 10-year rates, which makes complete sense. Small caps are extremely rate sensitive. Let's get off these anchored VWAPs for just a second, just to bring up rates again. I mean, as they pull back and we're no longer threatening that 4.5 breakout, right? That was kind of in here. Whoops, we did it once, came in, right? Whoop, doing it again, came right back in. So as long as we're underneath 4.5, I think small caps as a beneficiary to lower interest rates is absolutely a fairly straightforward play. If you tuned into the Wednesday midweek market update video as well, I mean, we had talked about how this is technically a higher low versus, if we just go back and use the S&P 500, this was a lower low. It was the only broad market index, I shouldn't say only because Dow is, of course, out there as well, at least of the three that we cover as our main influences, it was the only one that didn't make a lower low and have a daily trend reversal. This was all soft higher low action in the sideways range. The hourly trend was never down there. Hourly trend flips to down, and we have a daily higher low. And we just went out to a new daily higher high, brand new all-time high, which once again strikes me as being a big data point for the bulls. As of right now, even if you break the inverted hammer low, you could pull back, catch for support near, ideally, the range low at 288, sustain another daily higher low, and then continue in the upward direction. Even if you overshoot that into the daily 20, the lower bound of the weekly expected move, something that looks like this is also a decent probability, especially if we hear from Kevin Warsh, just to sort of front run the fundamental conversation we'll have in a minute here. If Kevin Warsh is going to kind of act in the way that the market thinks he's going to act, which is typically a little bit more dovish, right? He likes less Fed intervention. He's probably super hesitant to hike interest rates, especially, I mean, he's not he didn't fall off the turnip truck yesterday, depending on maybe who you ask, I suppose. But he knows that an interest rate hike isn't going to do anything to open up the Strait of Hormuz any faster, right? And, you know, I'm not special for saying that thesis here on the channel for the last handful of weeks or whatnot. I think the market's expectation of that is kind of wrong. So I wouldn't really be surprised if Kevin Warsh here acts as either incredibly neutral or maybe even just leans like, I think the market's maybe kind of getting it wrong. If he even hints remotely close at that, then I expect small caps, to continue to hang in here. So that's the look on the daily, the expected moves here. $300.81 on the top side. On the bottom side, you've got 285.09. Daily trend is up via the higher high, all-time high, intraday, even new closing all-time high on that Friday session. Let's go to the hourly chart. Let's see what's going on here. This is much more of an inverted head and shoulders. Never even got close to the Tuesday low in here. And instead, this was, I mean, maybe not ironically, but it was just a higher low naturally intraday on Thursday via the lack of pullback, if you will. So the big break and reclaim of this 288 into the end of the week is substantial. It's very obvious that if the market pulls back on an hourly, the best higher low is here, and maybe that aligns with a daily pullback as well. 288 is supportive, something in there, and continuation is the ideal bullish sequence. If we come in here and just consolidate and go up and out, obviously a bullish sequence, tailwind for the S&P 500. If this market comes in, sets a lower high, and then reattempts 288. I would say in here, there's maybe reason to be a bit more neutral. And then when and if the daily trend flips to down, you will naturally have a break of the daily 50 SMA, the blue moving average in here, which would coincide with a break of the left side low. That would be your first daily lower low. That would constitute a trend reversal. There's just nothing about this current configuration that states it should be an immediate plausibility early on in the coming week's worth of trade. Let's go ahead and grab a Fibonacci from the low up to the high. You can see your Fib 38.2 is in the neighborhood, not precise, but in the neighborhood of that 288. A little bit of a test and higher low there would satisfy the conditions for still an hourly bull flag. And honestly, could we come in from Thursday's news low up to the high? Would it be great if the market could respect this 38.2 on an hourly? Sure. That would even be, a stronger bull flag indication for higher prices, likely offering a tailwind once again to the risk on side of the market. It would speak to market breadth. Things would look good there. Also, just kind of seeing here before I flip that off, the 61.8 is confluence with that 288. Let's throw on the intraday anchored VWAPs and just see what we get there. Right at the upper portion of this prior balance range from the Thursday reversal anchor VWAP. That looks good, 291.75. I think the arguments are fairly well set for the critical inflection points out of the market currently. Let's take this thing over to, what about market internals, right? For our Russell side. Strong volume inflows, reflective of the same thing on Thursday. Friday respectful, Friday respectful, Friday respectful. Thursday really not all that bad as well. I mean, it looks fine. I would echo all the same sentiments as to what we talked about in the other index products. And if we take a look at the market profile, you have a little bit of toppling action that's possible here just because the inflection point I think is fairly clear. If you were to start taking out value area low, that might front run your opportunity to pull back underneath the low and kind of get closer to the range low, right? Which is just going to be in here, closer to the single prints. If I just do something that looks like that, your single prints from that Thursday breakout, right? So a little bit of toppling effect in the Russell side. Notice that your value area is higher. Your point of control is higher on that Thursday session versus the ES and the NQ that, of course, we've already taken a look at. With that said, let's go back on over to the platform here. Let's reset this. Let's take a look through some S&P sectors here. So in the context of what has happened so far over the last week's worth of trade, here is your weekly performance. We are led by none other, drumroll please, semiconductors, 3.81%. Then we're followed up by the XLP. In the introduction, I said that there have been some recent rotation into value-oriented plays. That's what I meant there. XLP is a defensive, lighter weight sector that's going to be your consumer staples. It's names like Walmart, Costco, things that people need to go buy. Colgate, it's your P&G, Procter & Gamble, right? Things people need on a day-to-day basis, more defensive as a play versus, growth forward technology, software, semiconductors, so on and so forth. So although there is a recent rotation into that risk off stuff, technically, SMH is still being bid here, up 3.81% on the week. Materials, I think kind of a little bit more neutral on those personally. XLF, you need that for a strong economy. And to me, up 2.11%, saving the day with that character change from now 2 weeks ago. Really decent looking action there. Here's discretionary, an okay snapback, real estate, industrials. Here's the much more defensive sectors like utilities and healthcare. They're still green. They're, of course, outperforming the S&P 500. But as we'll look at their daily charts in just a second, they're not really doing anything all that compelling. IGV has had a sharp pullback here. We do have some thoughts on that one coming up shortly. Same thing with the MAG 7 ETF and XLE at the bottom end of the barrel. We'll also throw it in there, XLK as a component, primarily driven by the weakness. You're seeing that here because of software and MAG 7 versus your SMH semiconductor selects in the upward direction. So let's jump into these charts. Generally, the read here is not overly risk off. I think we're just seeing some churning effect, some profit taking, if you will, in some of the super duper rallies that we've seen, some continued weakness in MAG 7, but nothing that's like, oh my God, sell it all, sell everything, and just get out of the markets altogether, right? If we look at the SMH here, you actually broke that right shoulder, right? So for all the bears who are like, okay, here we go, it's time to go on Thursday morning, just kind of flattened on the breakout up and over that 612.25. So SMH looks fine here. I would say that this is generally a higher low in the count. It does not do anything to violate the daily trend. Consolidation here would be great. You could even pull back, set incremental higher lows like that, go sideways for a week and then up and out. Sideways would honestly be a little bit more healthy at this point versus just straight line in the upward direction. If the market's going to get this wrong and you come back into here, again, I'm probably a little bit more partial to saying, maybe the market does this and then we're here, and then we figure it out. If we start going sideways, that becomes, question mark, do we now have the opportunity to break down from like what could be considered stage 3 topping base, where you're just churning sideways, getting distribution rather than accumulation in a lower base. So something to consider there on the SMH, but for now, at face value, headed into early next week, pretty obvious over under. If you're above this 612.25, really nothing bearish to say about semiconductors. Let's jump on into the XLP. As stated earlier, I mean, first of all, this thing has not been out to a new all-time high. So although, yeah, it seems like there's some value-oriented play taking place here, this chart is not outperforming that of the SMH semiconductors here. It's not outperforming the new highs that are set in tech. So I'm not really worried about that. I mean, if this was absolutely ripping, if we made a new pivot high in here and this was bringing the S&P 500 higher, I would be more concerned to say, okay, hang on a second. I don't know if I'm a buyer of this breakout in the S&P, but that's not the case. You could consolidate and go sideways here, and all you're doing is just playing catch up, allowing some breathing room, letting rotation take place. Money moves from place to place. People take profit where they need to, and then the money rotates where? Right back into semis as soon as the next, compelling argument, earnings report, whatever, blah, 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 is released for the market. Right? Maybe it's a new data center announcement. Maybe it's a new semiconductor announcement. Like, oh, we developed this new chip that's going to lower inference costs and AI is going to get a lot cheaper and we can continue to build this thing out, right? Who knows? So that's one possibility here. XLP. It's not outperforming on such a substantial margin where I would say, oh my goodness, this is a sell everything event. If we look at the XLB, it's the lightest weight sector. It looks like it's honestly poised for a breakout here over 52.3. I'm not really interested in trading the materials sector, but fine. I mean, this is okay. Consolidation here will at least be bullish pressure. That's not hurting the market. If we look at the XLF, remember our character change from here 2 weeks ago, finally breaking that resistance trend line. This is bullish. You're really not gonna derail the broad market. It's, at least the S&P 500. Of course, no financial representation in the Qs, but you're not gonna derail the S&P 500 broad marketplace if financials are breaking out of a bull flag after failing to break down sell side wise here through the descending triangle. It's just not gonna happen. So as the tied for second heaviest weight sector in the S&P, this looks great, making a new pivot high on the Friday session. That's really compelling in terms of keeping the bull market going, or at least if the market is going to pull back over on the tech side, this will dampen the impact of that pullback, specifically in the S&P. If we go on over to the XLY, we're not out of the woods here. I do have some concerns for this sector. We're underneath the moving average stack. I mean, this was really kind of a failed breakout on the highs. We have an unfilled gap above us. We could rally into here and still be setting a lower high. That's my concern on the XLY, noting that we did actually set a lower low, and also just keeping in mind that discretionary comes from what? Tesla and, of course, our Amazon, right? So long as those two Mag 7 names look kind of brutal, I don't know that I want to be overly aggressive on this chart. I would love to see a reclaim and this thing to firm up and go out to a new high. It's just not quite doing it yet. My longer term idea, and I've talked about this in the past, and I still think it could happen, right? From a weekly or monthly perspective, this is digestion higher. This is kind of look below and fail on a weekly perspective. Monthly perspective, does this build out some kind of, eventually it could be later this year, it could be next year, the year after. Does it build out some next leg higher in the future and just remain neutral to bullish in the meantime? It's a higher time frame idea. In the short term for next week, again, a little not nervous, but cautious, dare I say, of the lower high. If we jump on over to real estate, this looks great. This kind of continues, in my view, to support the idea that you're probably not going to get a hawkish Kevin Warsh. If the market really thought Kevin Warsh was going to come out here and hike interest rates, why would real estate be breaking out? That just makes zero sense, right? So we saw some headlines earlier in the week that mortgage demand was technically up on the week over week, even though interest rates were also up. So to me, I don't necessarily think I'm any smarter than any analyst out there. That would be a bizarre thing to think. I mean, your Morgan Stanley's, Goldman Sachs, JP Morgan's of the world, your Citadels of the world. I mean, they're paying these analysts hundreds of thousands, if not millions of dollars annually, right, to be the best research. I don't think they're getting it wrong necessarily. On the idea that Kevin Warsh is probably not going to go in there and hike interest rates, regardless of what the Fed Fund futures market says. And real estate's just kind of another example of that. If we go on over to industrials, this looks poised for a breakout straight up through these highs. Names come to mind like Caterpillar. I mean, talk about a nice little flag on the weekly here, up and out through that. Talk about CMI Cummins looking for the same low cheat setup if we can get up and out through there. JCI, as we know, looks pretty darn good over here. Failed breakout on Wednesday. Can we get back in gear and squeeze out any shorts up and over the high? Maybe. And then what about Honeywell? Any recovery here? Not quite. This is the thorn in the side based on their spinoff from, what was it, Honeywell Quantum or whatever they said there was, or correct me if I'm wrong, maybe it was nuclear. Regardless, Honeywell did not fare well through that, and then GE also looks like it wants higher here up and into this pivot from the left side. Anyways, that's XLI, and it does look good at the sector level for a potential move through 176.50. Utilities, once again, outperforming the S&P, but does this daily structure suggest that? Absolutely not. You're still catching these lower highs, which, you know, defensive rotation, yeah, it might be good to preserve some capital in here as the market's going lower, but you're not doing anything impressive in terms of really returning anything north, on a breakout or substantial trend move in the upward direction. It's going over to healthcare. This, kind of just balanced all week. It didn't really do anything wrong. It didn't really do anything right. I think there's some interesting healthcare plays out there right now, and we will talk about them as we get into our trade ideas. But you could go higher here, and that's fine. You could go lower here, and that's fine. And you could catch yourself for a higher low off the daily 20. I think this is kind of an either way sector. It's not my favorite to trade, but we'll watch and see where it goes as a defensive posture. XLC. Obviously, your Meta continues to be a big deal over here. Of course, your Google continues to be a big deal. But don't also forget that Disney is a part of XLC in the heavier weight phenomenon. As a matter of fact, let's go to the Analyze tab. Oh, look at that. It's already up. Live Nation actually looks good, but Take-Two, SATS, of course, is not going to help with the launch of SpaceX on the, SATS with an S, with the launch of SpaceX on Friday, just money coming straight out of this and going into SpaceX. That's kind of your main offenders, if you will, in the XLC. And I would maybe take the approach that, like the XLY on a high enough time frame, this is look below and fail. Do we suggest a higher low here? Can we at least keep it in play? And we'll watch from there. This has continued to be a threat underneath 115. It doesn't go anywhere. This still looks like bear flag to me on the daily. We know there are some concerning components here. So we'll pay very close attention to it, but if it can't go any lower than 110.50, I am going to file that somewhere in the back of my brain as a higher time frame idea, as just stated, for the future. Maybe there is a time to buy Meta on sale, so to speak. Maybe there is a time to really run over there and buy Google with both hands on this pullback here over the previous all-time high. I don't know about you, but kind of smash in what a weekly bar looks like, and you're dealing with a hammer there. So is Google buyable this week? Maybe, right? So there's some ideas in that XLC that honestly may support some semblance of a rebound off this 110.50 for the sector level. It's going over the IGV. I like the hold of the daily 50. I think there's likely trades here early next week, even if it's just a counter trend in the context of a big old failed breakout. It's something that I would entertain over the 91 stack. I mean, very just obvious 2 days sideways off the 50, buyers responding over the stage 1 base. Can they actually step it up for a weekly higher low, character change, and then go from there? We'll see. I mean, fairly ugly to just snap right through the 20 SMA, but we'll kind of see where this goes. You still have a declining daily 200, so of course that's kind of a flag against maybe an overly bullish thesis here, but watching this area very closely to see if we can't get up and out over the 2-day highs. You really have to keep in mind that IGV is a bifurcated sector. When I think about IGV, I think about the crapcos. I'm going to call them crapcos, and they're not necessarily crap, but you get my point. You think about your CRMs of the world. You think about your Workdays of the world. You think about your Monday.coms of the world. You think about perhaps, ServiceNow did get the golden blessing from the administration, but for now, we'll lump it into that category. You think about these things that are maybe a little bit more replaceable by AI. And of course, Adobe earnings on Thursday after hours does not help one bit. But then I think about something like a Snowflake, right? And I say to myself, hang on a second. I mean, that is not a bad look, right? You go on over to a DOCN, right? And you say, okay, this isn't necessarily a bad look holding up over here. You go to a Take-Two, TTWO, Take-Two software. This had a decent breakout over here. Which one am I thinking of? TWLO, sorry, TWLO. My apologies. I knew I was getting those things twisted. But here's your TWLO, right? Obviously different as well. So in IGV, and then maybe look at Oracle gapping down on earnings here. The market obviously doesn't like their debt. But go back over to the IGV, and there's winners and losers inside of this group. And I would not just let the proxy keep you away from some of those winners inside of it. So anyways, there's some commentary on that. Mag 7 ETF notably weak. The high in here was not as strong as others. Of course, we know that the double top triggered far earlier on Friday of last week versus some of the other patterns that have triggered for the lower lows, right? So this has offered a headwind to the market for a while now, and it's going to continue to offer a headwind to the market because as much as maybe you don't want to trade these, and trading the high beta makes more sense, and that's fine, but go back on over to your Analyze tab and you just, you pop in your S&P 500 and you're like, hang on a second, even though I might not like the Mag 7 for trading opportunities for the index level, 1, 2, 3, 4, 5, 6, 7. There they are. They are the heaviest weight components of the S&P 500 and the NASDAQ 100 as of right now. So it's hard to ignore the damage that's been done to this chart. And even if this does look good for a counter trend, which I think it does off the daily 200 SMA, you're probably talking about a lower high, either here at 67 or here at the neckline retest, or at least an attempt. Now, does the story turn around when and if there's a higher low versus the major low at the 200? Perhaps. But, as we've seen, it's pretty tough to look at Microsoft and say, wow, that looks good. What are we talking about here? This looks horrible. It's atrocious. It's one of the worst charts, I would argue, out there right now. So just not really getting the job done for the Mag 7 ETF. Let's go on over to this energy chart. I think it still looks constructive. I still think that you've got yourself some opportunity for a pennant here. The problem with it, and trade it at your own will, but it's just that you're too subject to headlines. Right? Headlines from the Strait of Hormuz. Is it open? Is it closed? Is the war over? Is the war back on? You're going to get sort of jerked around in here, and I just don't want to play that game. But does the chart look fine? Yeah, it does. Let's go to the XLK. A sharp pullback for sure, but we are back above the left shoulder in here. We're back over the 20 SMA as of Friday's close. You could also see you've got equal lows. We do not kiss the daily 50. I think that this one is fairly straightforward, up and over about 186.30s. Kind of gets you some thin structure retracement back up towards the highs. If you consolidate in here, I would be much more open-minded to sideways rather than calling it, okay, here we go, markets are going to crash and burn and go to zero. Lower odds of that. And instead, I would say, okay, kiss the 50, look below and fail on the head and shoulders neckline. Bears get all jazzed up in here. Oops, sorry, higher back up to new highs. Right, that would be more of the look on that. Let's jump into some of the ratio charts just to get a sense for, are we risk on, risk off? If you're not familiar with ratios in Thinkorswim, check out the video tutorial in the top right-hand corner. This still looks okay. This is definitely putting in some legwork to get up and through the 50. I'll go neutral to looking better. Very, very an improved look from the just straight up downtrend that we were experiencing through here. This could still use some work, so neutral to X. Neutral to X, we'll see if we can set some kind of a higher low and be constructive into the 50. We've talked about the concerns on this chart and on this chart for your lower highs. Anyhow, your risk off is starting to roll a little bit. Obviously, the concern here being some potential for a higher low, potential for a higher low. This is not broken through the 50 yet. I'm primarily concerned about these two. If I had to parse them out, I'd say staples. Let's get on into the A set and see what our specialty ratios suggest. Still looking good, trying to hold a higher low, but kind of dancing on the edge. Would like to see this really accelerate to the equal high, dancing to okay. This is not great. This is discretionary versus staples. This kind of is a hand-in-hand data point with what we mentioned in the intro. There has been a rotation into value. Right, that is what this line pointing lower, inherently implies. Our K does not look good, and a ratio down here. That's Kathy still underperforming, and you can see it here also. Your growth versus value on the IWF IWD. That's the Russell 1000 growth, Russell 1000 value. Not really suggesting a risk on environment. A little bit of a rotation there. So the question becomes: is this such a sharp unwind that we need a little bit of a counter trend? And does that give a lending hand here, a special helping hand here, so on and so forth. So that would be the primary watch. Is this ratio too oversold, and do we see a little bit of a bounce there, which would just signal more of a risk on rotation, right? We'll see if it sustains or turns into anything larger. As we take a look at gold, not really seeing any sort of defensive positioning from that. If we took a look at the bond relationship, this is still just one of the strongest risk on ratios we've seen in a while. The Bitcoin ratio, the Saylor Schiff ratio, is not turning back up through the zero mark, but we are finding a low, a little bit of support. I would be a proponent of a lower high in the range. Bitcoin has not played well through this at all. Say what you will about Saylor, but kind of with everybody knowing where he's at, with the positioning, is the market just going to come and take his money and then go higher? I don't know. We'll see. I don't want to get too conspiratorial about that one. We'll just continue to use it as a proxy for risk appetite. And right now, it's not really helping the bulls. I do like the copper bounce off of the lows in here. You could go on over to your something like XME and just take a look. You're kind of holding in here at the lows. Steel honestly looks good. STLD with this push up and out. So steel for your metals kind of hanging in there. Copper, though, a little bit more of a relevant metal for this cycle. Let's go on from copper over to our dollar and interest rates. The big idea here is, of course, dollar comes in on lower crude, lower rates, inflation expectations. We've talked about this chain reaction for weeks and weeks and weeks on end. Does the dollar continue to come down on Kevin Warsh this upcoming Wednesday? You have to watch 99.50. We can't answer this question yet. I would tend to lean in the direction that Mr. Warsh there is going to be dovish to neutral and not necessarily a major hawk, but we shall see. 2 o'clock on Wednesday is the day. Let's go on over to our inverted ZT. You can see a little bit of a pullback here, but probably still suggesting we have higher odds of a rate hike. Let's go on over to the Fed watch tool. Give this a refresh. Just make sure it's the latest in the background here. Yeah, market's still pricing in a rate hike as soon as December. One thing I will say is that earlier on in the week, before the headline reversal of the war, we were actually pricing in a secondary rate hike in here as soon as June of next year, and then immediately back down to this. And I think it was just higher for longer in this neighborhood. So steps in the right direction for the doves out there. But again, I think I've said it until I'm blue in the face already. This is the main event for next week. Kevin Warsh telling us, or I shouldn't even say telling us, but just addressing the market for the first time as the Fed chair. So expecting unchanged on interest rates. That's not really a big shocker. No big data earlier on in the week that is overly concerning. Maybe retail sales here on that Wednesday session, but I mean, everybody's eyes are just going to be all over Warsh on Wednesday. Jumping on over to the earnings insights, I did just want to point out what I was noticing here. A little bit of a slowdown in the market's expectations for a, it's actually a slight uptick. Sorry for drawing that in improperly, but it's only by what, 4 cents. So a little bit of a flattening out as the market digests the recent gains of the earnings cycle. Is that reasonable? Yeah, I mean, I don't think it's unreasonable. And if the market's going to go sideways up here, then fine. But generally, the market's still pricing in earnings growth. It's not expecting, if I just go back up here, there's your earnings growth. This is not a PE multiple expansion completely contingent upon lower rates. This is like, no, earnings are durable, hitting the bottom line. And if you scroll down, actually, what you'll see is that the PE ratio fell off a cliff over the last handful of trading sessions. Look at this. So there's actually room, believe it or not, for earnings to stagnate, rates come down, PE multiples expand, you get a multiple expansion on lower rates, and the market continues higher. So as a fundamentalist, if I just put my macro cap on for just a second, never go full macro, it does not look bad at all under the hood the more you look at it. If we go on over to the earnings calendar, obviously a slow week with the shortened holiday on Friday. I'd say Jabil is interesting there, as well as Kroger perhaps, and that's really it. I wouldn't get too hung up on anything else from the earnings calendar here. Let's get back on over to the platform. Let's take a look through the remainder of our supporting evidence. Starting with bonds, what do we see on this front? You could see here the inflation concerns are decreasing. The market knows that the labor market's strong. That's what this is. So kind of the same interpretation we've had on the channel here. And, why do we have that interpretation? Because we agree with the market. We don't come up with random theories. If we take a look at the LQD and just generally, these are credit spreads. They did move in the downward direction to end the week, unwinding some of the upward lift that was happening through here. That's generally a risk on indication. If we look at junk bonds in isolation, really sharp on that end of week rally. And also, remember, we talked about this on Wednesday. I'm not going to say junk bonds got it right this time because they were so wrong back here. But maybe in isolation, they did offer a little bit of something with that higher low versus the lower low and the overblown nature of what I would consider just positioning unwind in the S&P, not a fundamental shift in the appetite for risk, right? This is just like longs late to the party, punished, and then, right back to it. So that's junk bonds. Let's jump into our, total breath, a little bit better versus that Wednesday recording. My God, I was all over the place in that one. Thanks for a lot of the well wishes in the comment section. Look at your breadth expansion here, lower rates. We've talked about IWM and the thesis that breadth is expanding. Like we're literally seeing it with the all-time high there. We saw it with interest rates coming down. We've already seen the RSP. I showed you that. But here's the moving average. I mean, just it all aligns, right? This market is not necessarily gasping for air and saying like, oh my God, I'm on my last leg. Like this is fine stuff. If we look at, what was I trying to do? I was trying to stay on the total breadth screen, but rather go to the RSP again. There we go. New high over here, bullish, and then QQQE snapping right back up through these highs. Once again, looking pretty darn good for the breadth of the market overall. Let's take a look at volatility. Volatility got crushed into the end of last week. What we want to watch for is, again, more of a stabilization at the floor, like what we have over here, rather than a spike, right? That kind of situation gets a little hairy. The market's not really following the analog from October of last year perfectly. It has diverged from that a little bit, but we'll see if volatility can continue to come in and just act normal. We don't want to get to complacency levels, but we do want to act normal around, mid-teens, if you will, on the VIX. If we go on over to the VVIX, which is volatility of volatility, the big difference between October of last year here and then this current situation is that volatility is naturally lower. This, when you look at volatility of volatility, actually does look a lot more like that August. It was July 31st of 2025. That was a PCE inflation report that caused a little bit of a hiccup in the market over here, right? So that is looking a little bit more like the analog when you go deeper into the VVIX versus just top figure of the VIX. Go on over to the vol futures. Strong push back into contango. Honestly, a little bit too strong of a push for my taste. I would have preferred that we just stayed a bit more settled in here, honestly, and not gotten as steep. You're getting back into contango on this. One day VIX hasn't come down, but I do believe that this is largely due to your space X IPO and just some hedges going on in terms of a liquidity vacuum ahead of the release, right? Which, it happened a little bit, but into the close, I think SpaceX was already trading as if it were a mature name. Let's go on over to, that was the final of the supporting evidence, which means it's time for the core list of companies. Let's take a look and see what's going on with NVIDIA. What do we have happening here? I just think it's not the semiconductor to watch anymore. The growth story is kind of no longer there. The growth story is being spread out to other places. It's still one of the deepest and most liquid options chains, so it's worth trading as a day trader, right? But in terms of, do you really want to get involved in this for anything other than small day time frame ideas? Your money is probably better put in a vehicle elsewhere. But is this going to be double bottom? Is there some semblance of like turn this into inverted head and shoulders and then here? That'd be the main idea. I don't love doing anything overly aggressive in here until this sets up, in which case your 211 reclaim is going to be the move that possibly sends it back up towards this 220. Then up here at 230, we'll brighten those levels up when and if the time is relevant. But for now, just kind of laying low on NVIDIA. I do like the weekly pullback into this, but you probably got it once and you wanted a weekly higher low here and then some basing. So not out of the woods. Let's jump on over to Apple. Apple, a little ugly on the reversal from Thursday, but we know that Apple is defensive tech. As much as this is a clean setup for left and then, left side peak retest on the right, I don't know. Again, like, is Apple the best vehicle for your money? It's slow. It's kind of a 2.4 ATR. It's a defensive tech play at this point, right? The Stevie Wonder trade worked for all of about, 15 minutes intraday on Thursday. The flag got no traction on Friday, and instead we're just lower. Is this a massive bear flag? I don't know. I would try not to be overly bearish Apple as long as we're over the left side peak. But if we really start to fail underneath 288.65, I would really take a little bit of a lower aggression approach to Apple. So, is this the move? And then you go inverted head and shoulders support this one? Maybe. We'll take that in stride when and if it happens. Let's go on over to Microsoft. We sort of covered this already. Brutal sell-off. It probably deserves a counter trend, but anything in here that sets a lower high, just bearish. There's probably a point in time where Microsoft becomes cheap and you're like, geez, this is a no-brainer. Let me buy this thing in the long-term account, right? There's probably a point in time in here where that becomes the case. I just don't know if we're there yet. The market has severely punished Microsoft versus some of its other tech and Mag 7 peers. It was never really able to spend any more than a single day, which, mind you, on the gap up faded over its 200 SMA. It's still sloping in the downward direction. Again, likely, you wouldn't catch me dead short down here at the lowest low of an overextended move like that, but you're probably looking at a lower high under 412. This is a brutal chart. Let's go on over to this Amazon. Amazon is not any better. I mean, it's definitely not holding its left side peak. You got your double top just like the Mag 7 ETF, and he bounces off the 200. First problem is a lower high here. So you're going to need a little bit more basing activity in my view, ideally over the 200, and then you come out of it, set a higher low, and then go. Something like that may require a couple of weeks on Amazon. I don't know that you're just going to like V-shape off this low and go back out to highs. I mean, if I'm proven wrong, then that would be great because I still do believe that Amazon is one of the larger AI winners as a holistic company, from robotics to logistics to everything they got going on, AWS and beyond, chips, right? The Trainium chips, Gravitron chips. just to me, Amazon's kind of the full package. They got everything going on. So it's the place that I still want to be from a higher 90 billion foot view perspective. But in the short term, it's got some concerns here. We'll see if the 200 acts supportive. It's going over to Google. I think the weekly retest is interesting in this neighborhood. Previous left acting as support. I did like the hammer on Thursday. I did not like the action intraday on Friday. If this was going to set up more cleanly, ideally this would have been supported. It would have closed over the 50, setting up inverted head and shoulders here for higher to the top end of the range early next week. A little bit of a weak close here. We'll see what happens. I'm willing to give it the benefit of the doubt as long as it stays over 355.85 and can kind of support in this neighborhood. It did have relative strength through here. I'm still crediting it for that display of strength. It just needs to follow through now. So, how does that look? Maybe it's got to be this. And, the long really develops over the range high break to reclaim this previous set of lows. That's one potential configuration here for the Google chart. Let's go on over to Broadcom. One of the worst, it's heavyweight, as we saw in the scan list there, or what was it, Analyze tab. It's still the sixth heaviest weight component for the S&P, so it's hard to ignore, but the daily chart is just ugly. It's broken. It's under the 50. It's consolidating down here inside bar. I don't know what you do with it there. You look for a pop and fade off of 408 overhead supply, perhaps. I just don't see it. More competition just keeps stepping up, and more competition and Intel love makes me think that that's just the place to be now. So Broadcom, we'll see where it goes. Let's go on over to Metaverse. As mentioned earlier, another problem for the XLC alongside that Google reversal. If this rallies through here, you just got huge overhead supply, 601.25. Like maybe Microsoft, is it oversold in store for a counter trend? Perhaps. I'd be waiting for it short on 600. Again, 90,000 foot view. Does Meta get cheap at some point and become attractive as a, quote unquote value play down there? Maybe. I don't know exactly where that level is. I would really just rely on like monthly charts, monthly reversals there if it was going to happen. Yeah, it's just in the short term, the chart is not constructive at all. I wouldn't be looking to trade this on the long side in the short term unless it's just a counter trend to establish a lower high and then short again. Let's go on over to Tesla and see what's happening here. A lot of volatility on Tesla, like big down day, big up day, big down day, down again, fails to go lower high. There's a lot of volatility here. And I don't necessarily think a clean structure. The big level to at least pay attention to is the confluence of the 50 SMA and this 396.50. If you're above, do you get some kind of like inverted head and shoulders there? Retest the 200. Maybe we will we will drag this one down to the hourly chart. Maybe I need a sip of water here on the desk. Not yet. We'll keep talking through this one. This is the idea, thin structure retracement. When you get here, do you just reject and stabilize a daily lower high? It's just the structure is not so clear on Tesla, in my view. So as a day trading vehicle, sure, the options change just like NVIDIA, deep and wide, a lot of volatility, a lot of money to be made, a lot of money to be lost. But the structure here is not clean for any particular, A+ daily grade on the chart. JP Morgan working well for financials here, up and out of this little flag consolidation. Once again, bullish for the XLF, helping the narrative that once again, your S&P 500 is probably not going to sink and go to zero. If you go on over to MU, a little bit of a, I don't want to say disastrous close on Friday, but not as good as it should have been. Looking for a day two follow through up and over the prior day's high. MU back underneath 1,000 previous day's high, inverted hammer. It's going to be very obvious where the shorts can attack this. That's going to be underneath this 959 low of day from Friday. If you fail that, you're probably coming back into the daily 20. And then do we have a lower high attempt set on the daily? Perhaps. If you're looking at memory, I know it's not on the core list of companies, but SanDisk is your poster child. This is where you want to look for that opportunity there. If you're not already long from in here off the 20, you want the retest of about 1820 previous all-time high. That is SNDK versus MU. MU these days, it was on the core list of companies because, hey, we could trade the options here and it's not too spready. Very spready short-dated options, expensive short-dated options. You may as well trade the shares on this one or MUU, which by itself probably is in store for a split someday here. I mean, it's basically trading at the same level. It's just shy of 1,000 for the 2x lever on MU. Anyhow, let's go on over to AMD, see what's going on over here. I like the reclaim of this level. Unfortunate whenever they give you the professional gap up and make it a little trickier to get involved intraday. Nonetheless, on the hourly chart, right, what we're seeing is this start to emerge. So higher lows above that 485 gap fill reversals into Thursday's highs. Looks great for an hourly higher low. Looking to pick that up towards the top of the range. If you just go sideways, that's great. Call that your higher low, and the next trade is out in the blue skies over 523.85. The 50 SMA is catching up to price. The longer we go sideways, the better the opportunity, in my view, to try it again on a new extension play up and through the top of the range. Intel, my favorite chart in the markets right now. If you're in the group, you know exactly our thesis on this one. Share a little bit of it here on the weekend update with you guys. All I'm going to say is just do the math in terms of the percent return from the low up to the high, count how many weeks it's been tight and sideways as a keyword, and the rest is just fill in the blank. So looks great for higher, in my opinion. I'm waiting for this thing to go to 200. And we'll see if we can't remain involved, because I'm long Intel already from two different spots. But for now, let's take a look at the hourly chart. I mean, pretty straight up in terms of grind action on the Friday session. Any higher lows should ideally be set over 118.50. And then from there, you build out your right flag on the hourly, and then that's your trigger through the daily top end of the high tight flag. I'll just, there it is. So 130.50 is the name of the game. This is probably my favorite chart in markets right now. Go to a weekly chart, study this thing, do the math again in terms of what the percent return was from here up to here, and then calculate what we're looking at if we go up and out through 130. So really love the chart. I think a lot of people love this chart as well. I'm not, saying this is a unique viewpoint. I think a lot of people like Intel here, but it is just so obvious. I'll leave this on a weekly chart for just a second. Look at this structure on Intel's weekly, and then go look at NVIDIA, right? I'm like, okay, hang on a second here. You're telling me I want to be trading NVIDIA here in terms of the next 2x play, NVIDIA to 400? I don't think so, right? I don't think so. You go back and you look at Intel and you're like, okay, hang on a second. Intel to 200 as, a double or whatever you want to say. Intel to 200, I can see that. I could see this as a secondary opportunity. As an example, go back to SanDisk, right? SanDisk at whatever, 600 or whatever, now 2,000 at the highs of last week, right? It's the same idea on Intel. So anyhow, pleased to have a little spot in there for now and continue to look to add to it, honestly. Anyways, that is the core list of companies. Let's get on into some trade ideas. Let me reset this to a daily chart. I've got 10 of them for you today. It's quite a few. Rocket Lab is up first. Honestly, you could have done it on Friday, the look below and fail of the 50, but with the high volume, I would just keep an open mind. If you can do it again, look below and fail, and continue to prove that the left side peak has some validity here, and it's not going to, divert all the capital over to SpaceX, I think you have a long opportunity here on Rocket Lab 100. It's the round Jesse Livermore number. You've got your 50 SMA, left side peak. I think that looks pretty good. So look below and fail is the idea. Red to green move on Rocket Lab back up towards at least these highs and this prior low at 116.35. We'll see where it goes from there. Let's go over to UAL, United Airlines. This is a higher time frame idea on a weekly chart. Take a look at this, right? Lows, higher lows, and then is this poised for a huge breakout as crude perhaps continues to come in? I think it's possible. Right? If crude oil is going to come in, then your travel and leisure, primarily airlines, cruise lines, hotel bookings, and things of that nature, they should move in the upward direction, right? As all those prices fundamentally get cheaper because of input costs. So UAL, is it worth more on lower crude up and over 116 as a weekly ascending triangle breakout? I think there's something there to that. So watching for sustained headlines, obviously you'll be subject to headline volatility. If you want to play the entire basket going over your jets, this was not one of the 10 ideas, but if you want the basket, some well-rounded action, Delta has already done it in here off of the 75.60, and then AAL does not look as good, in my opinion, on higher timeframes. UAL looks like it has that cleanest weekly chart 116 level. So that's that. Let's go on over to, let's go to CRDO. CRDO, I think this is a pullback play up against this 239. Look below and fail on that level, or an inside day and then over inside day high to go higher. This has just offered insane relative strength as this entire push has been happening there, and the broad market was, of course, pulling back. So CRDO on relative strength, as long as you're over 239, looking for some sort of entry tactic, be it an inside bar, be it a look below and fail, be it a weak sideways and then a break through the flat top base, something of that nature, CRDO. Next up, TWLO, TWLO, which we had on the software run through. Look at the inside hammers here off of the 20. I think you either just play this over the Friday high, which is just going to be in there at like 206.50s. You just Brigade bolt that up and through, and you're targeting your left side peak in here, closer to about this 236.50 spot. That's your trade with a stop underneath whatever that day low is. Or if you just consolidate, I would let this be. It does have some relative strength on the gap and go. Nice peg setup. It did go higher here, of course. So watching this TWLO, really not selling off on aggressive volume. Look at the volume pattern here. Your volume is contracting as the pullback happens, meaning nobody really wants to sell this as much as they wanted to buy it back over here. So TWLO, interesting on that front. Let's go to NTAP, NetApp. For sake of just saying it, I am long this stock from back here, but I think there's potential ads over this, or at least worth watching as we pull back through this gap. Just like your TWLO we just saw, as it sells with the market, you got nothing in terms of major volume, especially relative to that earnings highest volume ever, right? So to me, looking for something, so I'm going to add here, or just an entirely new setup over like 162.25s. So can we do something like this, get more size on, it's been trimmed. Please don't misunderstand me. I'm not carrying the full position from here to there, no sales. I've trimmed down to very small size left, but do we get something that looks like that for new ads on NetApp? Could be the watch at 162.25. Next up, we've got BTDR, BitDR in the crypto miner turned data center space. One of the stronger names in that theme. I think there's some potential here over, this is an inside bar on Friday, up and over its high, $18 flat, give or take. We could just get rid of those 5 cents. Over 18, back up to this high. It looks better to me than something like your Irene, which I know, it doesn't look bad, but it looks better than Irene in my opinion. So BTDR is the one that I would focus on. Also, your ATR is just much wider, more bang for your buck, if you will. But remember, it cuts both ways. You could easily get very hurt on something like BitDR if you're not careful and managing your risk appropriately. Next up, CARR carrier. This is not CARR as in Avis Budget Group. This is CARR as in the cooling name. So hammer off the 6860 retest level after breaking the ascending triangle. Is there something to it up and over this high? Maybe. It's not my favorite of these watches, but I wanted to bundle all of this stuff together before jumping over to our healthcare theme. There are some healthcare names that look interesting. I'm not a big proponent of UNH, but I couldn't ignore this little flag happening over the left side peak at 403. Hammers on the Friday session. It's technically an inside bar. And if you look left, let's just go back out to a multi-year chart, right? This is that big sell-off where just a lot of things going on from earnings, legal battles, just a lot of stuff through here. So over that, you kind of have some thin-ish structure through that liquidation that was taking place. So what would a target be? I'm not saying we're going to go here in the blink of an eye, but something around this like 483 zone might not be the worst idea in the world. This left side low might also be a place to originally look for at this. I mean, we're still talking about a huge let's just go 438 is fine. Still a huge move from where we're at in there relative to the number of dollars. Percentage-wise, yeah, it's a little slower. It's the healthcare name. But, what's the percent move? I'm going to shake a stick at 7% when, what we were just looking at. BitDR could do that in a day. Probably not. But it's a respectable look. Your UNH options will be playable, I think, for that move if it's going to happen. Anyways, that's one of the healthcare names. The next healthcare name, we'll move from there to here. Eli Lilly, very clean look over the top of this flat top base breakout. Can this pullback offer something long in this neighborhood? A little bit better of an ATR meeting the threshold of that classic 3%. Anything over 1113 is just a flag. Right? Nice move through here. Helping the risk off sector, XLV move higher. Can we get support over the left side highs and ultimately get some sort of a move in the upward direction? And then finally, GH, Guardant Health in diagnostics over here. Rounded base, big break post earnings and flagging out now over the 20. Inside-ish bars on the two back-to-back hammers. Very well-defined breakout point at 133.50. I think from there, you are just looking naturally for higher. So Guardant Health, the last of the three finales, in the healthcare theme for today's additional ideas. With that being said, that's going to be the end of today's episode and installation of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Have yourself a fantastic rest of the weekend. Try to get out there and touch some grass. Remember, markets are closed on Friday, and Kevin Warsh and the FOMC meeting will happen on Wednesday. We'll probably live stream that here in the office at 2 o'clock. Probably start at like 1:50, 1:45. So be here or what do they say? Be square. Maybe you won't be square, but we'll be hanging out in the penthouse office if you'd like to join us. So with that being said, have a green trading week. And as always, I will see you in the next one.